Well, we're going to look at some 2023 changes to help small businesses and also small business owners with retirement plans. And we're really pleased to be joined by Mark Koppelmann of Financial Connex with an X.
That is
First
correct.
of all, very clever. How did you come up with that?
Well, the main reason for that is to make it easy for people to find it on the internet. I always believed in having a one-word name of a business, so I went with X and just played on it.
Excellent.
So we're out.
Well, how have you helped business owners in the past plan for the future, and is it a constantly evolving program?
It definitely is. Business owners are in a unique position, Neil, and the difference between business owners and most Americans is the fact that they have a parallel track to retirement. Mm-hmm. And the reason why they have that is because they own a business and the business itself has value. So what we do, our firm, is to help those business owners not only plan for their personal objectives, but also take into account both tracks to include the business value as well as their employer-sponsored plan. So it's an evolving process that requires a two-step approach. First, prior to retirement, you have steps which would include business valuation, would include your typical retirement planning, which is about what's the lifestyle you want to live, what's that going to look like. And then there's post-retirement. Post-retirement means when you get there, at what point are you using your business assets to fund that retirement? There's a tax planning piece to it. It all integrates, and ultimately what we try to do is help those business owners match what their personal goals are with their business assets.
Do you ever have anyone come to you, Mark, I guess on the front end of that program and say, well, I'd like to retire, but I think I'm going to have to find someone to take over my business. Do you offer advice in that as well?
I do. And actually, what happens most of the time, there's one or two avenues most business owners take. They're either going to pass it down to family or current employees, or they're going to look for a buyer, which becomes challenging depending on the market. But that's part of the pre-retirement planning. It's always important to engage some form of business broker or determine the value, as well as make a plan, set goals. And sometimes what I've seen in the past in my career is small business owners tend to wait a little bit too late. Mm-hmm. And by doing that, they don't maximize the value of that business. Whereas if they're getting the right advice on the front end, they can take a guide path to a successful retirement entry.
Makes perfect sense. Well, let's kind of get to know you, I suppose, just a little bit. Why don't we start with education? Where'd you go to school?
So I'm originally from Augusta, and after growing up in National Hills, I decided to go to Athens. I always wanted to go to UGA. A big Bulldog fan, always have been, always will be. So I took my show to Athens. While I was there, I met my wife, my final year of school. She's a graduate of Medical College of Georgia, so it kind of made it easy for us to see each other. I would come back on the weekends, and she'd come up to Athens. So pursued my bachelor's degree at Georgia. Upon completion, Andrew and I, we decided to make a move to Atlanta and relocate. The job prospects were better there than they were here at the time. And just started my career there, and she did the same. As I began my career early on, I continued my education, which took me to Kennesaw State University, where I earned a master's degree in business with a concentration in entrepreneurship. I've always had that belief in being a business owner. I'm a small business owner as well as a financial advisor, so I have a unique perspective that I'm able to bring to the table when I talk to business owners. I'm living it.
One of the writers of Augusta Business Daily is Dr. Rick Franza, who was at Kennesaw in the College of Business there. So that's a small world. That's fantastic. And along the way, after your MBA, what type of extra specific, I don't know if you would call it schooling or licensing, did you also go through?
Thanks, Neil. That's really important. So in my career, or in the financial advisory path. Individuals can stay as financial advisors and they become licensed, which you're able to sell securities. If you want to be licensed to sell insurance, you can do that. But in addition to that, you can take graduate level study courses very similar to becoming a CPA. And certified financial planners, they are required to take a certain path of courses, and then at the end of that, they have to take a certification exam. And it's a two-day exam that allows an individual to hold themselves out as a certified financial planner. So that's one aspect of it. In addition to that, I took some additional specialty training as it relates to employer-sponsored retirement planning.
And we're continuing to chat with Mark Koppelmann. And you can reach Mark online at financialconnex.com. And again, that is Connex with an X.
That's right.
Which really has a nice ring to it for sure. And which is excellent. We mentioned at the very beginning that there have been some changes in the new year, and it's called Secure 2.0. Can you share what that is and what are specific changes?
For business owners, the past few years have seen tremendous changes as it relates to retirement planning. It not only affects business owners, it also affects individuals. However, starting January 1st of 2023, Secure Act 2.0, which is the second installment of the original Secure Act, added some additional provisions that will go into effect this year as well as go into effect in future years. And for business owners, what's really important is to recognize that those changes just went into effect. It's time to start evaluating where you are in terms of your current retirement plan and or evaluate whether you want to offer one, because really what has transpired, one of the main provisions in the Act at this point are additional tax credits that are being offered to small business owners if they start a plan. There's also tax credits for those that have existing plans, but also do certain steps to earn that credit. So from a business perspective, it makes a lot of sense, not just from a numbers perspective because you get some tax benefits, but also your employee morale. That's the whole idea. So Secure Act was really enacted in order to get people to start saving more money. And in order to do that, legislation had to allow employers some benefit in order to help encourage that. And that's what we're seeing now. And because of that, we're going to see many of these provisions go into effect this year. But if you don't start taking steps now, you may miss out on some of the benefits that are now in place.
And let's run through some of those specifics for someone that may be watching. Is there a certain limit on the number of employees that you have?
There is. So if you have up to 50 employees, the rules are very specific as it relates to the credit. First 2 years, 100%, up to $1,000 per participant. After that, it graduates out into the fifth year. So there are certain parameters there for employers that have 50 employees. Above 50 employees, the credit starts to phase out as you have incrementally more employees. So really, the individual business owner who has 50 or less employees have a tremendous opportunity to benefit from this one specific provision. But those employers 50 to 100, there's still benefit there too. It's just not quite as much.
And how about changes maybe to IRA or Roth type plans?
Mainly IRA, which has been a big change over the past few years. Starting my career early on, just helping private clients and families and business owners. For years and years, the required distributions for IRAs, it was capped. It was 70.5. Everybody kind of knew how that played out. Well, in the initial Secure Act 1.0, which occurred in 2019, the age started to increase. So it went from 70.5 to 72. Starting this year, it's moving up from 72 to 73. So for those individuals who not necessarily are planning for retirement, but are in retirement, it's something that they need to consider. So maybe parent or somebody who's already there, that may be something they need to look at, because they may not need to take a distribution this year. That, in addition to, on the employer side, employer-sponsored plans, there are rules that have been allowed now that give employers the ability to code their contributions as Roth contributions. And in the past, everything was deferred. Mm-hmm. So really, the employee would defer their compensation. It would grow on a tax-deferred basis, and they'd take it out in retirement. Now, an employer can take their contributions and code it as Roth, which means to the employee, they have a tax implication, but the benefit is many years down the road, when they take that money out, they have the ability to take it tax-free, because Roth is a different setup in terms of retirement account.
Sure. And again, we're chatting with Mark Koppelmann, and Mark has a CFP and CRPS credential, and has been involved in helping companies and business people and families for decades now. And his website is financialconnex.com. And again, that's Connex with an X. So that's 2023. Let's look ahead a little further to 2024.
Part of the provisions, I think what's going to be really interesting in 2024 is you're going to have some catch-up situations for individuals who make over $145,000. Rules are going to change there, where when they make a catch-up contribution, in the past they had some limitations, but not many. Going forward, they're going to have to do it on an after-tax basis. So any employee that makes over $145,000, they're going to have to be aware of these changes in 2024. Additionally, another provision which I think families will be interested in is there's going to be a change in how assets that are held in 529 accounts, the disposition of those assets. Up until the change in the law, 529 money would go into the savings account, had a beneficiary, the money would grow, and then at the time that the individual beneficiary needed the money for funding school, they would take it out.
Right.
Well, there are many 529 accounts that, let's say your child got a scholarship, or somehow the school was funded in a different manner. Well, you have a balance that sits in that 529 account. And up until this year, if you had a balance, the rules were very specific on what you could do with that. But going forward, or the provision, the way it's written, is the individual beneficiary will have the ability to possibly roll that money into a retirement account. And that's going to be really interesting to see how money transitions, because that is a very significant change as it relates to 529 and retirement. I mean, it's twofold.
Wow. So if I'm understanding correctly, if I have a 9-year-old, if I have money that continues, and I expect at age 18, maybe she might want to go to Georgia Military College or AU, there's money there, but there would be a possibility not to use it for school and then use it for something else?
That is true. The way the provision is presented, I know it's very specific in terms of how that money is handled. There are rules around that, but yes.
Wow, fascinating. Exactly. And then, you're based on the plan and planning, and so if people are planning ahead to 2025, there's a few wrinkles that they need to know about.
Well, there are some changes in 2025, but I think the biggest changes, and this is more specific to individuals, are the changes in the required minimum distribution rules. By 2033, that's going to go up. It's going to be up to age 75. That's a big change. Like I said, it's been 70.5 for years and years, and since 2019, it's gone up. Now,
sure.
That being said, I think those changes are very appropriate and probably didn't happen soon enough, mainly because of the fact people are living much longer than they were in the past. So planning has changed over the years. In the past where statistically somebody might live to a certain age, totally different now. It's changed.
So when you go out to lunch in Evans or Martinez or what have you, and you bump into someone, do they ever say to you, Mark, what's the market like? What do you think? Do you give them a little overview?
I'll do that. And as we've talked about in the past, everybody has an opinion on the markets. Sure. But what I will say high level is 2022 was difficult for investors to absorb, mainly in their 401k accounts, because that's where their investments generally are. However, from my perspective and being in the business since the late 90s, it was a healthy thing. The markets needed that transition to a more normal capital market scenario. And the reason why I say that is because after 08 and 09, when we had a very difficult time, interest rates remained very low for a very long time, and that completely changed how money was invested. So you fast forward to late 2021, start of 2022, stock valuations were very high. So last year, I wasn't surprised at all that we saw a correction in the markets. The real question is, are we going to see some more collateral damage as a result of that? There's a possibility that, however, it's been healthy, which is a good thing. And so I think it sets us in a position that once we get beyond this period of time, maybe late 2023, early 2024, we're in a much more manageable position to buy stocks, bonds, whatever the case might be.
Any crystal ball on the Feds and rates?
Right now, the expectation is there's going to be definitely 25 basis points. It's most likely going to be 50 basis points. The real question is it going to be once or twice? And I think hopefully one increase in the interest rate environment that's fine. However, we've sustained so much in a short period of time. I think we need to let some of it flow through to the markets. I think we can do it a little bit too quickly, meaning the Fed. So hopefully that'll be the end of it, and then we'll see. Because actually what will happen is third, fourth quarter, earnings will come out, expectations will be here, and earnings will either be there or not. And then that's what's going to drive where stocks go at that point. The expectation, many experts believe that we're going to have a soft landing. We're not going to have a significant recession. However, there's always a caveat. If you increase the rates, twice at 50 basis points, that's a full 100. You could be in a recession very quickly.
Well, this has been a really topical, timely, interesting discussion, and Mark has some more information on his website, Financial Connex with an X.com, and we really appreciate the insight, and I hope some of our viewers and readers get in touch with you and continue the conversation.
Without a doubt. Please call us. We'll be glad to answer any questions.
Thanks again, Mark.
Thanks, Neil.